Good morning. This is Dylan Jovanet with Behind the Markets. Happy Friday. Today is Friday, August 7th, TGIF, and we are talking about gold. We're going to finish the week with gold. Today we're going to talk about gold 20,000, riffing off a note I'm going to discuss in a moment. So let's talk about gold. Is it ready to really make this kind of nice move? Because, it was up 4.3% Wednesday, which is the third largest gain this year. And a lot of folks are calling the bottom in. And, look, there are short-term scenarios that are really driving gold and longer-term scenarios that are driving gold. And the short-term scenarios really speak to gold between $5,000 and $6,000 in the short term, 6 months, 12 months, okay? In the long term, though, there are a couple of things that are happening that I'm going to discuss with you today that talk about gold, how it could get to 20,000 over the next 3 to 4 years. And I'm going to explain that right now. So first of all, if you think about what's been driving gold, really, it's been based on three things over recent years. One is the Fed. Folks just thought after basically the financial crisis that the Fed just didn't have the stomach to raise rates. They were just going to run the economy hot. That was going to be deflationary. And they thought they were kind of feckless that way. The second thing are interest rates, of course, which we talk about here. And remember, what affects interest rates? In large part, the debt that we have. I mean, again, the Fed could set interest rates, but the bond market's really going to set interest rates in a significant way. So the Fed could say, we want the rate to be at 3.5, 4, and the yield in the actual market, where sovereign funds and central banks and all the other players play, is going to actually set the real rate. And the more debt we push out, especially refinance short-term debt, people demand higher rates for that. That pushes interest rates up, as we talk about here all the time. And that really is what we're talking about there. And of course, the third big structural thing that has sent this up is central bank buying, which is also tied to the other two. Central bank buying are other countries that are really reducing reliance on the US dollar as the world's reserve currency. And this really started happening during Trump's first term as he added $7.4 trillion in debt. It accelerated in Biden's term as he added $7.2 trillion in debt, but even worse, froze Russian central bank assets, which was considered a no-no. And of course, we're back in Trump's second term and he's adding, it looks like, $8 trillion in debt. So basically, central banks say, I'm not buying US dollar denominated assets. You guys are running your house like crazy people. We'll just move money from US treasuries into gold. That's what central banks and sovereign wealth funds are doing, which is why gold has actually surpassed the US dollar for the first time in 40 years as a reserve currency asset. Very, very sadly. We will regret that. Mark my words. Anyway, but Wednesday's advance suggests that in the short term, the weaker US dollar is having a bigger impact on yields. And, that's starting to come into play too. But, in the long term, there's a couple of things happen. I have some notes here. The World Gold Council says central banks and sovereign wealth funds bought a net 289 metric tons in the second quarter, which is a record. And it's up 62% from the same period last year. So again, you have that big bank buying starting to come in, central bank and sovereign wealth fund buying. And, you get the sense that the Iran conflict set off kind of a flight to gold, even at our expense. This kind of sell America trade that seems to be going on in the background. But, Kevin Smith of Crescat Capital is out with a note talking about how much steam might be in the rally, basically. And he sees the price of gold surging to 20,000 over the next 4 years or sooner if the Fed gets a little, I'll explain in a moment here. And, what he says, and I'm going to quote him, is, quote, with the precious metal now under accumulation by global central banks, extending the trend line points to a price target for gold of 20,000 in approximately 4 years, although we suspect global M2 could accelerate given the current fiscal imbalances and geopolitical climate to shorten this timeline. So gold 20,000 in 3 to 4 years. If you accelerate out what central banks and sovereign wealth funds are doing, what that looks like on supply and demand is higher prices for gold in the next 3 to 4 years, bottom line. And again, he's talking about the same thing that we talk about, fiscal imbalances, the U.S.'s house not being in order, M2 money supply, Fed, and of course, geopolitics, the geopolitical climate, war, China, a bunch of other things that we've got to watch out for. His second scenario actually uses a gold to S&P 500 ratio model, and it assumes, now bear with me here, a drastic stock market decline of 50% and an ensuing dollar devaluation too. And look, this might sound a little crazy to you, but what he says today is when you look at historic valuations right now and how much the AI trade is like predecessor bubbles, like .com, et cetera, what he's saying is that each of those prior bubbles, when they popped, they sent gold much higher. And I'm going to quote him once again. Each of the prior peaks, he's referring to the .com bubble and other ones, was catalyzed by a stock market crash from historic large cap equity valuations and a substantial dollar devaluation. But a 50% lower in the S&P 500 combined with a 5.25 gold S&P 500 multiple, which is well below its 1980 peak of 7.58, but above its 1933 peak of 4.76, also gets us to our $20,000 price target for gold. Again, this is a bit of a long shot, the second scenario, but not really absurd. I mean, think about it. What he's saying basically is markets crash. You have bubbles, markets crash. And if this one looks like prior market crashes, gold can really soar. I mean, think about it. After the .com bubble and the global financial crisis, the S&P 500 logged falls of 50.4% and 57.4% respectively. So if you think the AI bubble could inflict as much pain on the stock market as these two prior incidents, there's a big case for gold. As a matter of fact, I would argue you could almost set your watch to it. We've seen over the past 30 years that we get one crash about 4.8 years on average. So basically, there is a really strong case for 20,000 gold, whether it's through a market crash, an S&P market crash, which, again, happens when that happens, or just central bank and sovereign wealth fund accumulation as the U.S.'s fiscal house stays out of order. So if you think our federal government, our president and the Senate and House and all those yo-yos we have running things, if you think they're going to get our fiscal house in order, and by the way, yo-yos from both parties, they're both yo-yos when it comes to money. If you think they're going to get our house in order, our fiscal house in order in the next 4 years, ignore this message. If you think politicians, being what they are not likely to get our fiscal house in order, 20,000 gold looks very realistic. Anyway, that's all I have for you today. Have a wonderful weekend. I'll see you Monday.